Because the thing with property tax, it doesn't matter if the asset is fully depreciated, it's still subject to property tax. If we're brought in earlier, we can help manage, right, that liability by saying, you may be overpaying for this. Do you really have this asset from 1994? Is this computer from 1994 still on the books, right? In some states, they apply a trend factor to that. You would think, oh, it's fully depreciated, it should have like a really low depreciation rate. No, they add that trend factor of like 1.37 and it pushes up the value of that 1970 asset. And so taxpayers need to be aware of that.
So, since we've kind of brought us down to a fundamental level, when do you see clients typically reach out, or when do you get involved from a client perspective? Is it more on the proactive side? We know we have, we're moving, or is it on the reactive side of like, oh, whoopsies, the county figured out I was here. They asked for a declaration or a rendition. Where do you find yourself kind of coming in the kind of compliance life cycle with clients?
Okay. So usually when clients need compliance work done, it's more a proactive approach on their side to say, hey, let me look for a compliance provider, which is a great thing on their end, because what that does, it helps them to craft a story, craft a position, be more proactive in, reporting their assets correctly, right? Where we see some of the issue on the reactive side is when that does not happen and then they receive an assessment notice and they may do some calculations, say, wait a minute now, why am I going to pay this much tax now for this property? Then they may call and say, can you look at this? Why are we paying so much, right? As opposed to if we're brought in earlier, we can help manage, right, that liability by saying, you may be overpaying for this. Do you really have this asset from 1994? Is this computer from 1994 still on the books, right? Especially those older manufacturing facilities. I'm like, do you really have that assets from 1960 something? Is it really there? Right? Because the thing with property tax, it doesn't matter if the asset is fully depreciated, it's still subject to property tax. And in some states, they apply a trend factor to that. So even though that asset, you would think, oh, it's fully depreciated, it should have like a really low depreciation rate. No, they add that trend factor of like 1.37 and it pushes up the value of that 1970 asset. And so taxpayers need to be aware of that, right? So if you don't have the asset there and it's still sitting on your book, remove it. We call it ghost asset in the property tax world because you're paying on assets that are not there. You're overpaying, right? Another thing also that we can help our clients with is, if you have a business that does a lot of rebuilds, right? Rebuild machinery and equipment, to extend the life of the equipment or to make it more efficient. You have to think, if the original asset, right, was rebuilt, that means some form of the cost on the original asset is no longer there, right? Parts were moved out, right? Things were replaced to extend the life and to create efficiencies, right? And usually, clients would just do an accelerated depreciation to depreciate that original asset down, to a lower net book value when that happens, right? And then put the new rebuild asset on the books. Now, for property tax purpose, somebody's going to just pick that fixed asset register and say, oh, okay, the asset was purchased for, 1 million, right? But they haven't considered that there's a rebuild asset also on the book. So you're really overpaying in property tax. So having someone proactively go in and assess that, review that, make the adjustment to that cost before it's reported, that would really control and reduce some of that property
So it's
tax
kind of like a
liability.
double counting on the same asset
Yes, double
when you
count
have a
on the same.
rebuild. Okay.
Correct. Not that the original asset needs to be fully eliminated, but it needs to be adjusted because that asset is still there. It's just some of the original costs that apply to that asset is no longer there because of the rebuild. So, we have a methodology that we use to extract that cost out based on the rebuild cost and what the original cost was, and we index that.
I was going to say, is that hard to prove out? Like if you were to get audited, like, hey, this was the value of the engine that came out, and then this is the value of the engine that came in. So, and when it's, 40 years old, yeah, just the math
Yeah.
seems like a lot
Yeah.
of math.
Yeah, I know. So we use a trend factor that's available in independent third party data,
So these are kind of
right?
like
So it's not,
industry standards of as to like
yeah,
what
so we're not,
these would
yeah,
mean.
and correct. And so what we do, we actually provide that with the reporting to show them the adjustment that was made. So it's transparent, right? The assessor will see what adjustments were made and the basis of that adjustment.
What happens if a company hasn't ever reported?
Oh, that can be interesting depending on the state you're in. Some states have a what you call a regular audit program, like California, North Carolina, Tennessee, right? And so, if you have not reported, the first thing I would say, do a health check. Do a health check to figure out where do you need to report, and also um, do an analysis and evaluate how much you would owe, right? If you report, and where do you have the potential to be audited, and what's the audit period or statute for those jurisdiction, and calculate that out. Some of the penalties can be just burdensome. That's the word I would use. Like in North Carolina, the penalties they're pretty steep. They're heavy. They go up to 50%, depending on how far back you have not reported. So I would say if you have not previously reported, start doing, request a health check, figure out how much you would owe if you started to comply, and then how much you could potentially owe if you're audited.
And the for property tax, typically, right, there's not really mitigation programs like a voluntary disclosure. Does it sometimes apply, or will amnesty programs sometimes cover that? Not
Well,
typically.
unfortunately, property tax does not
Yeah.
have like an amnesty program or a voluntary disclosure. Only one state, Kentucky, has a program similar to that for you to do. But for property tax, that does not exist. If they catch you, they're just going to penalize you for not reporting, and also the penalty of late payments because you did not pay the taxes for those years either. So sometimes you're double penalize late filing plus late payments.
Mm.
Well, yeah, because let's say you have like one giant asset in a jurisdiction, they would kind of is there a statute of limitations on? I know it's like if you never filed anything, is it realistically how far your place in service date is as to like when that asset went into service?
So I'm
Is
going
that
to use that favorite word again. It
yeah.
depends. Property tax is
Cultivation. It
local.
depends. That's our new
It's
tagline.
not
Yeah, I mean,
it's
it's
not
the
uniform across
Right.
jurisdictions, right?
yeah, it's,
So some states may be 3 years back, but if you did not comply, they can go all the way back to when you started
Yep.
business in their jurisdiction, which is really what the parameters are. Is like when did you start business in their jurisdiction, right? And they start as of the next assessment lien date, right? So if you start a business like September 1, 1990, right, they're going to start assessing you as of January 1, 1991, right? The next
wow.
assessment lien date.
And is there a possibility in some of these jurisdictions to negotiate with the assessors?
Sometimes it's possible to negotiate, but then, you have to ask, what benefits would
Sure.
the assessing jurisdictions get,
Right,
negotiate.
right. What's in it for them? Right.
Right. But if you are a very important taxpayer in that jurisdiction, right, and there's a possibility that the taxes that will be levied would, you know, negatively impact the business, the jurisdiction may be scared that you may pick up if it's easy for you to pick up and go to another jurisdiction. So they may be open to negotiating, right? While some other jurisdictions, they're like, just pay. We know you can't lift up all these heavy manufacturing equipment you have here and just easily move it to somewhere else. But they can easily put a lien on it.
Mm.
Wow.
Do you have, and I'm not going to ask you for your least favorite, but do you have like a favorite jurisdiction that you like working with? Like, for example, Texas has a very generous voluntary disclosure. Texas gets a bad rap of like they're very aggressive, all of these things. But their VDA program is great. It's interest and penalty waiver, 4-year look back. You can remediate one tax type, even if you're filing in all of the others. And the agents are just generally very lovely. Do you have a favorite jurisdiction that you've dealt with?
Yeah, so Texas is on the list, the top list of some of the states that's really pro property tax. I would say, like, consultants love Texas, right? Because the assessors, or sometimes they use third party appraisers. They're usually more understanding of how value works and what goes into it and what may impact value. So a lot of times you get a lot of positive outcome in Texas. Georgia is also a very good one. Once you develop those relationships with those assessing jurisdictions and develop trust through transparency, you get a lot done. Now, some of there's other states that may be a little bit challenging, and they're not challenging sometimes because it's difficult to work with the jurisdictions, but the time it takes to get things done. So, for example, when you think of property tax appeals, trying to appeal a value, it takes a
Yeah.
long time to turn in California, right?
Yeah.
You could be waiting
They're
one and
big.
a half before things, get done. And just it could be volume, right? And how much resources they have at the county level to handle that. And then you have some, interesting states like Oregon and Washington where they look at property a little bit different. And sometimes those property are valued at the state level. And so you have to deal with the state on those valuation, even though after they've set the valuation, they push it down to like the county and the jurisdiction level. So sometimes that can be challenging, having to deal with multiple kind of contacts to connect with to get those value issues resolved.
Yeah, and I guess are there certain triggers from your mind where it is worthwhile for a taxpayer to entertain appealing? I mean, because we can sit here all day and be like, we don't like our, the property taxes we have to pay, right? But, they are what they are. And, but I guess, are there triggers for taxpayers to think about in this decision to appeal or not?
Absolutely. So, for example, if clients have recently done like an expansion, right, or an acquisition or a new build, it's a perfect time to have a property tax professional come in, look at what was done, and help them through that, especially with the reporting side and just working with the jurisdiction on value. It's always good to work proactively with the jurisdictions on these matters because nobody wants to, move off their number that they decided on after they've issued the assessment notice or the tax bill. It's easier to work with them and say, we believe these adjustments need to be made, right? And then they finalize the value rather than after they finalize the value, you're like, oh, we're not moving that much. We already set our budget and we're counting on that tax, right? To pay for that new red shiny fire engine, right? Nobody wants to do that. Another trigger is if you find that your property tax is significantly increasing each year and you don't understand why. You haven't made significant additions, right? Um, and you need to know why. Why is my taxes so high? It may beg to have someone look at it and see what's driving that. Sometimes assessing jurisdictions can make errors. Like, I can tell you an example of a client I had that all of a sudden their value just spiked up. And when I looked, it was real property. And when I looked at the record card, they had a whole building that doesn't exist
Oh,
from the client site, right? Like, I'm not sure where that building came from. Let's do a site visit. It's not there, right? And so that removed a significant amount of value. Also, assessors also can make errors in terms of putting the wrong square footage
ah,
on buildings, right? So they may have a much larger or much smaller building depending on what they're using, and that can drive value. So it's important to also look at that. Another thing is that if you've not looked at your fixed asset listing in a while to review it and say, do we still have these things? Do we even still use these things, right? It would be a good opportunity to have someone come in and review it, right? Because you don't want to pay for assets that you don't have. And if the assets are idle and not expected to be brought back fully into operation, in some states they do offer you a value adjustment on those, sometimes 10% of whatever the cost of those assets are. And then also, if you have a operation in which your machinery or equipment is not operating at full capacity. So for example, you purchase the equipment and it could make 100 widgets per hour. And because it's getting older now and you have to put all this maintenance cost and expense into just making sure that the machinery work, and it's only making 50 widgets per hour. That's a huge case for value adjustment, right? Because then it's not operating at its full capacity.
mm-hmm.
Functionally, something is wrong with it, right? And so we need to take that into consideration when looking at value. And then also, it's not only what's going on inside the business, but also outside the business, externally. So if you're in an industry, if your client is in an industry that is really suffering, low demand, right? And they've seen their revenues drop significantly from the prior year, right? Because, maybe they have competition that came in and pretty much made their product obsolete. So now there's not a high demand for it. That's what you call economic obsolescence, right? You can come in and actually say, hey, look at my client's, P&L doesn't look too great year over year. This is what's happening. And, one of the things, a lot of times taxpayers will think, oh, that's just the market. That's exactly what drives value. Right? The market drives value. And so even though sometimes you're looking at, business, personal property on an asset by asset basis, what is going on in the economy directly impacts the value of that income producing asset, right?
So depending on, a company's capitalization policies, are there assets that can be expensed that are so they don't show up in a depreciation schedule that you would still need to assess personal property tax on?
Oh, that's such a great question because that is an area of exposure for a
Okay.
lot of payers. So, not because it didn't get capitalized, that doesn't mean it's not subject to property tax, right? So, they have to be reported. California is known to really comb through that GL, right, to pick up those expensed assets, those supplies, right? And so, it's very important for taxpayers to keep a record of those expensed assets year over year. And then also have some kind of company policy on how those expense assets are disposed of. Because if you don't have that policy, then if you buy something and it's going to only last for 3 years and it gets disposed of, and you don't have a process of disposing those expense items, then you're going to keep on reporting them year over year, and they're not there. So it's important to have a company policy that says, okay, we expensed, purchases under X amount, and the policy is to dispose those every 3 or 4 years, right? And that helps to secure that supporting documentation, especially in an audit, right? To really reduce that tax exposure that could potentially be there.
Well, yeah, because I could see that with computers, right? You spend, let's say you're a fairly large company, you spend, anywhere from $2,000 to $5,000 on a laptop, right? And maybe
Mhm.
you expense them because it's your capitalization policies, $20,000 or whatever it is, right? And technology has a fairly high churn rate because
Mhm.
traveling with it gets beat up and, at some point they just die. So you could, in theory, like if you expensed it, it's in your P&L, so it didn't hit your depreciation schedule, you're not taking your 3 years makers on it or whatever it is,
Mhm.
then it's in your kind of rendition schedule from a property tax perspective, but you
Right.
got me a new laptop in 3 years, and so but no one's ever really tracking the placement of that asset, so you could still
Right.
kind of paying tax.
That's correct. Correct. And that's why it's important to have some type of tracking process for those expensed assets. It's very important, especially for companies have like a lot of spare parts
Mm,
that
Mm,
they expense.
yeah.
It could be significant. And so it's important to really have that policy in place, right? And also have a process in place to track and keep track of those.
what makes kind of from an expense perspective, what makes something an asset versus like a supply?
Okay, so it depends on how long it will you expect it to last for. Usually, supplies is looked at as consumables,
Right.
so it'll be consumed within one
Okay.
year. And the wonderful thing with property tax, the way they usually ask for you to report supplies is taking 1/12 of whatever is sitting there on the balance. So basically, you're estimating what your average monthly supplies would be, right? As opposed to your asset that they're depreciating, right? It's just they apply the depreciation to whatever the cost is on the books.
Okay. So because you could just say Apple is your vendor, right? And you can buy
Mhm.
laptops and you can buy, headphones. So one is kind of, or maybe that's, I don't know. One could be a supply, but if I heard you correctly, you still take 1/12 of your value of supply. So does that include like
Correct,
pens, pencils, notebook, computer?
correct, correct,
Oh, I don't
correct.
think I knew that.
Yeah, yeah. So you're
Kind
like,
of
and companies who have
included.
fuel, like fuel supplies, packaging
Right.
supplies, right?
Mhm.
Those you take that 1/12. Yes.
Okay. And so does that only exist for like that 1 year, or does that still
It's new every
show
year. So
up?
every year you have to look at what the value is for that year and then divide it by 12. Yes, for the supplies. And it makes sense because you're looking at it's consumables, things that you're going to use up
Right.
within the year, right? So it's not going to,
Mhm.
I mean,
So it
yeah,
shows up and
maybe
then
it
goes
won't sit
off and
there
then
2 or 3
shows up
years,
and
but it's expected to
okay.
be consumed
Right.
in a year. Yeah. And there's one more thing that's really important: inventory. Now, some states tax inventory and some provide a form of exemption, like Georgia, Texas, they provide that Freeport exemption, Arkansas, Mississippi provides that warehouse exemption. And it's very important, sometimes clients really like, why do I have to pay property tax on this inventory? Why isn't all of my inventory exempt, right? Because some states like Georgia, you may, they look at what you ship outside the state, right? Within a year. Texas looks at it within 175 days. You have to ship it outside the state within 175 years in order for it to receive that exemption. So they're pretty much looking at what happened in the year before in order to estimate how much of your inventory that's sitting there as of January 1 is subject to that exemption. But in Georgia, you have something called, inventory held for more than 12 months, right? That's not subject to a Freeport exemption. And sometimes, clients need to look at why is that inventory sitting there, right? Why wasn't that shipped out? Is it sitting there because is it slow moving inventory? Have we lost a customer that no longer wants that inventory? That information is important because you can take the reason for that slow moving inventory, the inventory sitting there, and ask for an obsolescence on that, right?
Mhm.
If it is
Mhm.
a valid case as to why the inventory is not churning, right? For that. So just
And how do you prove that, I guess?
so basically, if you had a customer, right, the year before,
Sure.
you no longer have the customer and you had built up that inventory with that specialized product for that customer and they no longer need it, right? Then you provide information. We no longer have this customer. Here's the end of the contract. As a result of that, we have these inventories. And it was an unforeseen
Sure.
action, right? So those things can, or if that product is now obsolete,
Sure.
right? So now think about, during the pandemic, you may have a lot of companies who made masks,
Mm.
who
Hmm.
made tests, right? COVID testing. Do you think those are like really in high demand right now? So those companies probably have a high inventory on those, right? So those would be like types of in companies that you look at and say, you have quite a number of inventory that's subject to tax here. Why is it moving? Why is it not moving? And get those facts to bring to the assessor to say, we have these sitting here. Don't have a market for it. It's not in
Right.
high demand anymore, right? Can we receive some type of obsolescence value adjustment on these?
And is that usually like a formal appeal for that, or is that something that maybe
It
you're
could be
working with
both.
the? Okay.
It could be both.
Okay.
So you can proactively work, and that's why it's so important to get property tax professionals in early because you could proactively work and build that into the compliance function, right?
Gotcha.
By reaching out to the assessor, doing a cover letter, discussing the matter with them before it even comes to a point where the assessment notice is issued and then
Yeah.
you need to do an appeal. So now you're really catching up, right?
Sure.
In terms of getting all that information ready. So yes, it can be handled both ways, but it's always better to handle things in a proactive stance. It's really an uphill battle sometimes trying to do the appeals, but it's worth it, especially if you're paying a significant amount of property tax. It's always worth it to do an appeal. And that's the recourse that's given to taxpayers. It's not over until that appeal has been heard and a decision has been made.
Do you find that, we're getting ready to wrap up, but do you find that property tax is a heavily litigated area of tax?
It depends on the type of industry you're in. If you're in an industry like the utilities area,
Mm.
where it's significant high tax liability, you may find that there,
Okay.
right? But for the most part, you can, I wouldn't say litigation in the form of, going to court. But yes, in terms of appealing and going and presenting your case
Right.
before an appeal board,
Yeah.
yes. Because that's really the only tool the taxpayer has in their belt to really get the value that they're seeking,
Yeah.
right?
Well, I guess, I've
So
showed up twice to the city and county of Denver being like, I disagree. Like, my house is this big and you valued it as if it was this big. I disagree. And I lost each time. So maybe because I didn't know you, but
yeah. But yeah, I would encourage taxpayers, look at what the tax impact is, right? So if you think the value is high, how much you think it should be based on an analysis that's done,
right.
right? And look at the delta. Is it worth it to spend that much to go after this much in
Sure.
difference in tax liability? So there's like a common sense check that's also done with that. Um, and just, and also when you appeal and get a value reduction, that goes forward.
Right.
So that base carries forward. So you do benefit
Sure.
from going through with an appeal and getting a reduction, right? So it kind of resets that
Right,
base for the.
because because that's something that is taxed every single year until
Correct.
you prove that it's no longer there, right? Throwing it
Correct.
back to our
Correct.
1974 example of our machine that, hasn't been there since,
Correct.
1982. But
But you also have to be aware in the real property space, there's some jurisdictions that reassess real property every 2, 3, 4, sometimes 5 years.
mhm,
And a lot of times taxpayers get caught off guard because if you do a reassessment every 5 years, they've been paying taxes on the same value for 5 years. And
Mhm.
all of a sudden the property gets reassessed and they get like $2 million increase because of course the market has changed, there's more development. And so, you
Mhm.
have to be aware and plan and forecast these increases because it can be a shock to the system when some of these properties are
Sure.
well,
reassessed.
Right.
and just from like a kind of fundamental, like relatable level, Denver does their reevaluations every 2 years from, like a homeowner perspective, but
Mhm.
your valuation window is like 18 months in arrears. So you could look at, Zillow and be like, well, my house is only worth $7,000, 70,000. Good. I'm missing a lot of zeros here,
Mhm.
is worth this much now, but your assessment window was, happened 18 months
Correct.
ago over a 2-year period. And so
Correct.
you,
When things
not
were
every,
completely different.
right, not
So
everyone
that's why
has this
assessment mandate is key.
historical, right? Like COVID broke the Denver real estate market. And so when I got my reassessment in 2024, it was based on like COVID values of 2021. And you're like, this is cuckoo bananas. I can sell my house for today, which is the cash that's coming out of my wallet today, for $300,000 less than I could in 2021. Right. So these just
Yeah.
valuations and data availability is hard to
Yeah.
monitor. And as a tax
Yeah.
professional,
That's some of the challenge. Yeah.
it's hard.
Yeah, there's some challenges there with property tax in that aspect. There's a lag in when they actually look at it. So, for example, your company may be going through a tough time now, right? However, they're not looking at what's going on now. They're
Yep.
looking on what's
Looking
going on as of
at
that
the
assessment
past.
lien date, right? So
Yeah.
they're probably looking at the prior year, what transpired in the prior year. So you won't get the benefit of what's going on now until next year
If you're still there, right?
if you're still there. So there's a
Yeah.
lag in that benefit, especially for like real property valuation. There's definitely a lag in when you can really request that adjustment.
Yeah. Well, we keep bringing up new issues and we could talk to you all day, but for the sake of everyone else, if they want to know more, they should don't call me. I'll just refer you to Marcia. Um, so we love that you are on our team now. And thank you so much for your time and your knowledge. And this was just, great to be able to provide insight into an area of tax that I have not yet practiced. And now won't have to because you are a resource.
Right. Look
Well,
out for the referrals.
well, thank you so much. It was a pleasure, and I hope you'll be a convert to property tax. I mean, honestly, property tax is fun. There's just so much
Oh,
to think about when it comes to property tax.
well, we're just grateful that you're here. So we
Right?
I
and ask you the question.
tried.
Yeah.
All right. Thank
Well,
you.
thank you so much. This was Saltivation. Till next time.